Okay, so let's get started with going over the top six credit mistakes that people make and how it can cost them thousands of dollars. So, today we're going to go through what is your credit score, how it's calculated, and most importantly, how do you improve your credit? So, when looking at credit, credit scores are the foundation for everything: credit cards, buying a home, buying a car, obtaining the best interest rate with the lowest points. So, when we think of credit, and you're in a situation where you might be confused about your credit score, or you're stressed about the score, you're overwhelmed because you feel like you're at your wits end and don't know what to do to improve it, or you're uncertain to why your score is where it is and what steps you need to take to improve it. If you are feeling any of these, I completely understand, and I'll help you to understand it, and we will help you to improve it also. So let's start with, who am I? I'm a mortgage banker. I work for a company called Neighborhood Loans, and I have a loan team that I work with. And myself and Rachel are licensed loan officers who will help people get home loans. And we also guide people on how to improve their credit to get them into the best position possible to be able to buy a home. We started in the business back in 2001. Combined, we've sold and financed over 10,000 homes. So last year alone, we did 500 no cost credit improvement plans for clients to help them achieve their dream of home ownership. And when doing those credit plans, we do look at the individual person situation and see if you need down payment assistance for a home purchase. If you do, it can be done. So there's a review that you'll see on the screen that in January, we helped a young lady. She came to us and had a 551 credit score. Within doing six simple steps, she was able to get her score up to 680. She was out buying her multifamily property for her and her children to live in and getting rental income, creating wealth with real estate. And the benefit is getting down payment assistance. So when we buy a house, it's myself and Rachel are our main points of contact along with our processor, but we do have a full team that helps get us from start to finish. So along the process, there's a lot of people that work on your loan and look into your credit and are working on your paperwork. So, as you're going through the process, just be prepared that you'll talk to a lot of people. So let's get into credit. And what do credit scores mean? So credit scores actually can have a zero score, or you can go all the way up to 850. Along the way, when you look at credit that is poor or very bad or fair, you're going to see different interest rates along with fees, points, and costs associated with it. So the goal is to get your credit score as high as you can to incur the least amount of fees and get the best rate for you and the best terms. So let's look at credit reports and the difference of credit reports. Now, if you have Credit Karma, you have reporting from your banks or your credit cards that tell you what your credit score is. If you come to a lender like us, you may see that when we pull your credit, it's actually a different score than what you may see. So I want to explain why. So for lending, we use what's called a tri-merged credit report. So there are three credit bureaus. There's Experian, TransUnion, and Equifax. When looking at the scoring, the underwriter is going to use the middle score of that for their decision making. So when applying for a mortgage, please note that there is a credit report that's specifically for mortgage lenders. And this credit score algorithm was created to determine your ability or willingness for long term loan repayment. So, this credit scoring module is different than what you're going to see for things like credit cards and cars. which are a shorter term loan repayment. And that is the score typically that you'll see on Credit Karma or Experian, or your banking apps. So when we pull the credit, don't be surprised if a loan officer has a different score than what you may see. And it's not necessarily where it's lower when we pull it, it sometimes could be higher. So let's look at the common mistakes when it comes to credit. So people will come to me and they'll say, well, I'll just pay down my credit cards and my scores will immediately go up. There is some truth to that, but not entirely. So let's explore the types of credit first, so we have a firm understanding of the differences of the types. So let's look at revolving credit. That's like a credit card. Basically, what it means is, or a home equity line. So when you take out that line of credit, you can use it and then you pay it, and that line is then re-available for you to charge on again. So that's essentially what revolving credit is. Now, an installment type of credit is where you will make payments and eventually that item it will be gone. So think of that as like a car or student loans. So when you have a personal loan, a student loan, once you continue to make those payments and it's gone, then it's closed from your credit report as a paid item or paid trade line. Now, this type of credit has a large impact on your credit. If you were to miss a car payment and become 30 days or 60 days late, you're going to see a dramatic drop in your score. It's also going to take quite a long time for that score to come back up and recover from that item. So the difference between an installment and a revolving is that the installment's going to have a fixed end date, where revolving will stay open indefinitely, or it will have a term end, like for a home equity line of credit. You want to keep and manage it responsibly, and you'll want to make sure that you're continuing to make payments on time for all types of credit that you're utilizing. So then the other type of credit is a mortgage loan. So on a mortgage loan is an installment type of loan. So it has a term and date that is specifically used for real estate. And the types of real estate loans are a fixed rate, adjustable rate, ARM, FHA, VA, conventional, and USDA loans. So when you're looking at financing a home purchase, this allows you to carry that debt for decades. So typical loan term that most people will pick is a 30-year loan. There are 15-year and 25-year loan terms also. This also, like an installment loan, has a very large impact on your credit. So if you were to miss a mortgage payment, you're going to see a pretty significant drop in your credit score if that item is late. So looking at the amount of a mortgage loan typically will have a much larger limit and a longer repayment term than other installment loans. So let's look at how long it takes for credit scores to increase after paying down debt. And it's varied, of course, on different factors as far as how much you pay down and your total credit profile. So these are kind of good estimates. So when we look at credit cards and that you've paid those down, you will see an impact typically within 1 to 2 billing cycles. So when looking at credit card debt, you want to make sure that you're keeping it at a responsible usage or utilization. So the key is you want to keep that utilization at 30% or lower of what your total credit limit is. To get the biggest increase in your credit score, if you can get those revolving credit cards down to 10%, that's going to give you your biggest lift. Now, if you're looking at building credit and just establishing it, let's say you don't have any credit and you're getting, let's say, a secure credit card. What I tell people is literally you can go out and buy a loaf of bread and then pay the bill when it comes. It's going to show good activity on your credit and be able to help increase your score. When we look at auto loans and installment loans, so student loans, installment loans, you're going to see an increase in your score or an update in your score in about 1 to 3 months. So if now on the flip side of that, if you were to pay an installment loan late, like a car payment late, it could take you up to a year to recover from that. Same with the mortgage. So if you were to pay off an installment loan, so let's say you have a small student loan that's left and you wanted to pay it off to increase your credit, it actually will not increase your credit because when you pay that item off, it's closed out and zeroed out on your credit report. So you may actually see a couple point dip that it will be an immediate result. However, in a few months, you'll see it go up because that good reporting of that item being paid. So the key thing is when it comes to credit cards, because utilization, which we'll get to in the presentation, is key. You want to know when your creditor reports to the credit agency. And the date is important because you're going to want to make sure that your utilization is in line for that reporting schedule. So let's look at immediate impact. You may see a month or two down the line for the credit cards. Long-term improvement will be paying off something. Now, if you were to pay something like a collection or a large debt, I don't suggest paying those off until actually somebody looks at it and can run your credit through a simulator and see if paying a collection will help. But long-term improvement is for larger debts will take several months, like if you were to make some car payments. Consistency is the key. Keep your payments on time at all times when possible. So when looking at collections, what I do is I'll analyze people's credit and see if that collection makes a difference. Here's a true life story. Today I ran somebody's credit. She had 5 collections. They were all very old, but no new open credit. She was about to go and pay all of those collections, which in turn would have dropped her score by 40 points and not helped her at all. And the only thing she actually needed to do was open a credit card and wait 6 months, and her score would be 640. So knowing how to fix it is key because you don't want to just shoot in the dark and guess. So why does paying off collections lead to a temporary reduction in credit score, even though paying a collection is usually a good idea? So this is why it happens. When you pay off a collection account, it shows that the account is paid or settled. But on the flip side, what it can do is it shows activity on an old debt and it's showing a new activity. So what happens is it could temporarily dip your score when that happens. So that's why you want to make sure that you're having somebody run your credit through a simulator and not just guessing, should I pay this? It also can re-age your account. So when you call the creditor, they call you, or you pay something, it could just re-age that account, which then in turn can hurt your credit again. So you'll want to make sure lay out that plan before you start just paying things. So paying derogatory things sometimes can help. And there are some things that actually have a higher weight when it comes to a derogatory item than others if you were to pay it. So let's look at credit and what comprises credit. The biggest thing that comprises your credit score, 35% of your total credit score is based on your credit payment history. Now, if you don't have any credit, that's fine. We'll work to establish credit and help have you build strong credit from the beginning. 30% is your total credit utilization that you have. And when you look at credit utilization, don't look at your total credit utilization of all of your credit that's outstanding. Look at each individual card because each individual item or card could be the thing that's impacting your score. 15% of your credit is comprised about how long you've had it. So let's see, why would that matter? Let's say you have a credit score that's a little bit lower and you want to work to improve it. So you know that your balances are high. And let's say you have student loans that are in deferment. If you had those student loans from, let's say, 2013, they've been out there for a long time, but they're sitting in deferment. If you went on an income based repayment plan for your student loans and you were paying, let's say, $5 a month, and it's showing positive payment history, now you have two things working in your favor. You have on time payment history, and you have a very old item that you're making payments on. So you're going to see your score increase faster than somebody if they didn't have student loans and didn't go that route. So the age of the credit item is important also. So the different types of credit you have matter too. So if your credit is all credit cards, it's fine. But when you get a mortgage, you're going to see an increase further on your score because it's a different type of credit that you're utilizing. And then frequency of credit applications is only 10% of your score. So you see that uh, with multiple inquiries, a lot of times people will tell me that they have inquiries and that's what's causing their score to be low. That's actually a very small portion of your score and has very little impact on your score. And we'll go through, how many points in a few slides. So let's talk about disputing credit and that you can just dispute everything and it's going to remove everything negative off of your credit. So when we look at disputing items that are actually yours, it is not a good reason. It's not a good thing for you to dispute it. And here's the reason why. It's unlikely to work. It's going to be a lot of time, effort, and energy for you to go through the process of disputing an item if it's legitimately yours. Because the creditors work very closely with the credit bureaus. And what happens is they will show that the item is disputed, but then it shows resolved. So you may see a fake increase on your score where when we from the lending side see that a bunch of things are disputed, we have to calculate what your score would be without those disputes. And your score that is artificially high is not the actual score we'll be able to use. So it can also backfire. If, let's say, it's a collection, it's old, and it's yours, and you dispute it, it actually could backfire because it could re-age that debt. And if it re-ages that debt, then it will re-impact your score as if it was something new and re-hurt your credit. So you don't want to do that. If it's truly not yours, then make sure you have a police report and you have documentation to show that it's not yours. Also, with the underwriters and during the loan process, we usually need an explanation of, is this your debt? So I will ask people, was this your debt? Did something happen? And did life happen? We do ask that you explain what happened if there are a lot of collections. And we understand that life happens. We just want to make sure nobody stole your identity and that you're the real person applying for credit. So focus on resolution. Sometimes you pay off the debt, sometimes you negotiate, or you just leave them and rebuild positive credit history. So we'll come up with a plan for you that's the best plan for you, for your situation, and how fast you need it to rebuild. Some people need to buy, if a house in 2 to 3 months, some 6 months, some 12. So depending on what your timeline looks like, we'll tell you what's actually possible. So when you file a dispute, let's say it's not your debt and it's truly something that's not yours. How it works is when you file this dispute, you will reach out to the creditors and you let them know that there is an issue. You reach out to the credit bureaus. They have 30 days to investigate this item. The creditors have 30 days to respond with evidence and validity that it is your debt. Once they respond, if they cannot prove that it's yours, they do have to remove it. However, if they do show that that debt does belong to you, it does show up on your credit report. It shows item and then it shows resolved by creditor, which basically means that someone has disputed it on your behalf or you did, and the creditor has proven that it is in fact your debt. So if it's resolved in your favor and it is removed, then it's going to show disputed, zero balance, removed. However, if it is still there and the dispute verbiage is there, that's when we'll have to say, okay, we will need to get this dispute verbiage removed. You need to agree with it, and it can delay your approval process. So inquiries. Let's look at inquiries. When you have an inquiry on your credit, you are able to shop for a loan and you are able to talk to different lenders. You see the largest impact in the drop of your score, not from when you reach out to one lender or two lenders in the same industry. Where you see the biggest drop is when you change industries. So you apply for a credit card, you didn't get approved. Then you go to apply for a car, you don't get approved. Then you go apply for a mortgage. What's happening is you then are dropping your credit because it's so many different industries that are pulling your credit. Now, if you're going to get a car and they run your credit a million times, yes, you will see a drop in your score, but you will see that the score will actually go back up in a couple of months once you've reestablished credit. When it comes to a hard inquiry, it is about a 5-point drop in your score. So it's usually a short-term drop. It's not a long-term thing that's going to last forever. And if you do want to get the dispute or the inquiries removed, they are the easiest thing to get removed out of all types of negative debt. So let's look at not improving credit. If it's okay, this is way too hard, I am not going to do this, I'm just kind of stick my head in the sand. Let me show you how that can cost you thousands and thousands of dollars. So let's look at from a house standpoint. If you were to purchase a $290,000 purchase price, let's say you had a loan amount at $279,000. If we look at the difference of payment from a 615 credit score, which the monthly payment would be about $1,730 without taxes and insurance. If you had a 720 credit score, that same payment would be $1,662. Now, realistically, the savings with the higher credit score is $68. It's not a huge impact when you look at it just from a monthly standpoint. However, let's look at it and see why it is important. When it comes to a home loan and you're looking at prepaying that mortgage to save yourself interest over the life of the loan, if you take that same $68 and apply it towards your principal every single month, then over a 30-year loan, you're saving about $24,000. Now, You take that $68 difference and apply it towards that mortgage, you're saving $59,800 in interest. Your total savings by that better credit score is $84,000 over the life of that loan. And you're going to pay off your loan 3 years sooner. So the important thing is just knowing that the higher your score is, the better it is. And then when it comes to a home loan, you want to pay extra towards your principal anytime that you can to shorten the term of the loan and the total amount of interest that you're paying over the life of that loan. So, is overutilization causing your score to be low? If the overutilization, let's say your credit cards, you know that your credit cards are the reason your score is low. Look at using the snowball method of debt reduction to get your finances in line. So, what is the snowball method? The snowball method is when you take all of your debts and you're going to write them down in order of balance from the lowest all the way to the largest. And then what you're going to do is you're going to make all your normal minimum payments on all of those items. Looking at it and saying, I have extra money each month to apply towards this debt to pay it down and to get myself out of debt. You're going to take the smallest debt with the extra money and just keep putting it towards that balance of that smallest item first. And then once you get that first one paid off, that's awesome. Take the minimum payment from the first one, apply it with the extra towards the second one, and keep going. And you're going to see as debts keep getting paid off, the amount that you have available to pay to the next item keeps increasing, kind of like that snowball going down the hill. So let's look at this in a real life example. Let's say you have $200 extra a month that you're going to apply towards debt. You have 4 credit cards and they're all maxed out. And you have a balance of $1,650, $2,450, $3,750, and $4,150. So you have $12,000 total in debt. And you're thinking, oh my gosh, with $200, I'm never going to pay this off because the interest keeps accruing, right? Each month on the credit cards. And the average interest on a credit card right now is 28%. So let's say we start with the smallest debt. You want to focus on paying off that first debt while continuing to make the $50 minimum on the other debts. So each month you'll pay $250 towards the first one. So you have the $50 minimum plus the $200. And then if you keep going down the line, you're going to see that you are able to pay off those items in about 20 months. So the more money you have to add towards those balances each time is going to help you to increase your credit score because your utilization is going down and you're seeing positive gains on your credit. Plus, you're also going to feel better because you feel like you're not at the end of, kind of the road. Does anyone have any questions right now? If so, you can unmute your phone or type it in the chat. Okay. So let's look at not using credit. I have a lot of people that come to me that say, I hate credit cards. People have had things in the past where they've gotten themselves into a situation and they've cut up all the cards and they just don't want to use them. Think of credit like a garden. If you don't plant and water the seed, it won't grow. If you don't use credit, you won't grow a credit score. It's kind of counterproductive. We think if we pay cash for everything that and we use our money wisely, that we're doing good, but that's just not how the scoring model works, and it doesn't help us all to get better scores. So let's look at using credit responsibly. So you want to open cards wisely. You want to diversify the type of credit that you're getting. So you don't want to open a bunch of credit cards or a bunch of personal loans or installment loans. More is not better. You want to use them effectively and wisely and have different types of credit. So if you did an installment loan and a revolving loan, that's going to give you a good foundation. And use it responsibly. Remember, you want to use less than 30% of utilization if at all possible, and ideally down to 10. You want to always make the minimum payment on time because that's going to build payment history and it's going to keep that card open longer. Using the cards wisely is the main thing. Don't overcharge on the cards. And when we talk about utilization, remember when I said you want to make sure you know what day they're reporting? Here's a scenario. Let's say your credit card has a limit of $1,000. Your brakes went out on the car and you had to charge $1,400. You're over your limit on the card, but you know that your payday is on the 30th of the month. Well, if they report to the credit agency on the 15th, you're going to have a credit limit that's over the balance, or you're going to have a balance over the limit. So you're overutilized. You're going to see an impact on your score negatively. Now, if you're able to pay that card down to less than 30% before they report to the credit agency, you'll actually see your score increase. So know what day that they report and just try to keep your utilization below that 35% on the day that they report to the credit bureaus. Keep the cards open. A lot of time people will not use cards, like you have a store card like Kohl's or something like that that you don't use. You'll want to use it once a quarter. Go buy something small to keep that item open and active so they don't close the card on you. And in another important thing, I had a girl today that had bought furniture. She went 30 days late on the furniture credit card. Unbeknownst to her, they closed the credit card. They marked it as a collection because she was late and she had no idea. So make sure that you're trying to keep these cards current and on time because you don't want the creditor closing it on you. And in her case, she had to work with the creditor she called and they said, oh, we're so sorry. They reinstated her credit and they're working on getting it fixed. So let's look at authorized user. Sometimes people will come to me and say that they got put on their cousin's credit card as an authorized user, or they bought trade lines. And when looking at an authorized user, if you are an authorized user on someone's card, it can backfire and hurt your score. So do not buy trade lines. If you see it online that says, we will increase your score, just buy the trade line. It has limited impact on your credit history because when you're an authorized user on someone's card, it is not building your credit history. It may give you a score. However, when the underwriter peels back that credit, they're going to look at it and say, okay, if this is an authorized user account, is it somebody within the household that you're contributing to? And we can show that it's your credit and it's impacted and applied towards you. If we can't, then the underwriter will not look at that credit as legitimate, and not that it's not legitimate, but it's not yours and it's not helping your credit profile to show that you in fact are credit worthy. As an authorized user, you have no legal obligation for that payment because you're not responsible for making that payment. The lender may look at it as not a true reflective idea of your true credit worthiness. And it doesn't show that you have the ability to maintain or establish debt independently of somebody else. So it does not also help build a diverse credit profile. So looking at it and saying, okay, establish credit of your own and having that strong credit profile of your own with your own mix. Also, you could have a negative impact, because what if that person misses their payment? Then that late payment is on your credit and you had no control over it. So establishing your own credit is key, and maintaining it wisely is also important, because it's going to show and establish your credit history and that you have the ability to repay in your name. So let's look at, if you had something bad in your past, that it will prevent you from buying something like a house. So under the right conditions, you can still qualify for a VA, USDA, FHA loan, even while somebody is in bankruptcy for Chapter 13. So a bankruptcy is going to stay on your credit report for 7 to 10 years, depending on the type of bankruptcy. Collections and judgments will report for 7 years or until satisfied. Tax liens are reported for 7 years, and depending on the lien, it can show up in a different portion of your credit that you have an open lien. Inaccuracies also will stay on your credit. So if somebody was to apply for credit, or the credit bureau had a wrong phone number, or not phone number, but credit social security number, or birthday for you, then that will be notated on your credit also. But let's look at buying after a bankruptcy. So if you are in an FHA loan, or you want to buy in with an FHA loan, but you're in Chapter 13, after you make 12 months of on-time payments, and the trustee will approve the purchase after you get something under contract, you are able to purchase. Now, if it's dismissed or discharged, you have to wait 2 years after dismissal or discharge date. And when it comes to buying during bankruptcy, you want to make sure that your monthly required payments are to your trustee are made on time, and they are the correct balance. So if your agreement is you have to pay $600 a month, then you want to make sure that every month $600 is taken out of your account. Some bankruptcy attorneys will take less on some months that have shorter, or they'll take more in weeks that are short, or months that have shorter weeks, and then they'll take more in months that have longer number of weeks. You want to make sure that if it's 600, that 600 is taken out every single month, because if 1 month they take out 500, well, then your payments aren't made on time. While it works for them, the rules are not the same for lending. So basically, this is make the payment on time and make sure it's the full amount. And you want to make it before 5 p.m. on the last Friday of the month, because anything after 5 p.m. is next business day. So if you have a Chapter 7, it's a 2-year wait for discharge for an FHA loan. If you're buying with a conventional loan, Chapter 13 is 2 years after discharge. Chapter 7 is 4 years. So let's look at what scores are actually needed for a home loan. So for an FHA loan, the minimum credit score is 500 with 10% down. Not all lenders do this, so you want to make sure that you're working with a lender that does. 580 is the score that's needed for 3.5% down. Loan limits for 2025 have recently increased. For an FHA loan, maximum loan amount for an FHA loan is $524,225. That's for a single family home. If you're going to a 2, 3, or 4 unit, it is higher than that. Conventional loan, minimum credit score is 620. Maximum loan amount is $806,500. VA loan, there is no loan limit with full entitlement. Now, there technically is no credit score requirement either for a VA loan. However, some lenders do require 580 or 620, depending on the lender for the score. So they could have what's called an overlay, which is a rule on top of a rule. A USDA loan, minimum credit score is 640. If you're buying in Illinois, as an example, Kane County, maximum purchase price is $398,600. You also have tighter debt to income requirements for USDA loans. A jumbo loan, if somebody's buying a multi-million dollar house or something over the 806, they're going to require 680 to 700 depending on the lender for the credit score. Non-qualified mortgage. This is for our self-employed individuals, bank statement earners, 1099, profit and loss, asset depletion, and investors that are using debt coverage ratio loans. Typically, it's about 660 is the credit score. Our loan limit at our company is $3 million for that type of loan. A reverse mortgage, if somebody is at the age where they're looking at possibly doing a reverse mortgage, there's actually no credit score requirement, and the loan limit is $1,149,000. So let's look at what we've learned, at this point today. Credit can be fixed. All credit can be fixed. It can take time. So you want to start fixing your credit as early in the process as possible. So that way you're not heartbroken if it's going to take a little bit longer. Disputing items on your credit is not the answer. And inquiries are not what's causing your score to be low. Look at the utilization, look at the age, look at the diversity. There's other things that are affecting it. And not improving your credit will cost you thousands of dollars. Remember, it's not overnight. Create the plan and then follow it. And bad credit isn't the end of the world. We've all had hiccups, we've all had challenges. It's looking at it and saying, can I restart my life tomorrow and get on the right path for credit? So I hope everybody feels confident in now understanding their credit, and that you can see that credit improvement will help you to purchase properties, expand your portfolio, build wealth with real estate. Now, if you want to spend more time where I personally look at your credit, I'm happy to do so. There is not a cost for it. You're not obligated to work with me. My goal is that I can earn your business for lending. And if you schedule an appointment with me, that's my appointment link. I will sit down and have a credit consultation with you. I'll create your credit improvement plan and I will send it to you. When you go to the link, then you'll pick your day, you pick your time, and you set the appointment. So if anyone has any questions, I'm happy to hang around and answer any questions. If not, I definitely appreciate the fact that, you came and spent your time with me and you, spent your evening. And sorry, but again, about the glitch of getting in. I'll stop the recording.